Hi, I'm Andrew Silverman. I'm going to talk about my latest note. Going to share my screen right now so you can take a look. All right. So yeah, I'm Andrew Silverman, tax policy analyst at Bloomberg Intelligence here with my latest note. And this one is about some of the provisions in the House's One Big Beautiful Bill that you may not have heard anything about, but these are really key nonetheless to certain industries like banks, the real estate sector, even fitness clubs and tax compliance software makers like Intuit. So let's start with opportunity zones. You may remember opportunity zones from the Tax Cuts and Jobs Act. These are lower income areas that states can designate that can draw tax advantaged investment. Opportunity zone investors get deferral and then some forgiveness of their gains. The One Big Beautiful Bill would extend opportunity zones through 2033, but would require states to designate at least 1/3 of their opportunity zones to rural areas. The opportunity zone tax regime is great for investors, obviously, but it's also great for the banks that are funding these real estate projects and the real estate companies that are building in these zones. There's a provision that allows real estate companies to steer investment into their own properties to improve them with opportunity zone money. So that's been a major benefit to the real estate industry. So it's great for companies like CBRE, Jones Lang LaSalle. It's also great for banks that lend to these building projects like JP Morgan and Citibank. The One Big Beautiful Bill also expanded the low-income housing tax credit. This was in the bipartisan tax bill that passed the House last year, but it was never taken up by the Senate. The One Big Beautiful Bill would increase the 9% allocation by 12.5%, but for a longer term than the bipartisan bill would have, that bill would have just phased out at the end of this year, of 2025. But the one in the House's One Big Beautiful Bill would last through 2029. The accounting firm Novogradac has estimated that this provision will grow lower-income housing by about 34,000, by more than 34,000 homes by the end of 2035. Then the House bill would also cut the ability of sports teams owners to amortize their intangibles in half. I've been talking to Damian Sessauer about this. So what are we talking about here? Well, sports team owners can get the gradual devaluation of their players' contracts, their TV rights, their trademarks, and a whole range of different really valuable assets against their income from ticket sales, merchandising, and other very sort of profitable ventures. So effectively for many teams, this reduces their tax bill to about zero. So for hedge fund managers like David Tepper and real estate investors like Stephen Ross, if those tax deductions exceed the income from their sports teams, they can then start netting it against their other income. I mean, it's not unlimited. There are obviously some major limitations that take some planning, but it's possible. ProPublica actually talked about this, estimated that David Tepper gets about $140 million annually in amortization deductions from the Panthers. His team makes about $550 million in revenue per year. But when you look at a team like the Packers, for example, which issues an annual report, and you can take a look at it. It's very interesting. Only 6% of that ends up being taxable income, and it appears at least that that amount is pre-amortization. So there's what $100 million in amortization deductions that Tepper wouldn't have to use for Jaguar's income that he could use to reduce the tax on his hedge fund income. So we essentially posit in the note that the 50% reduction in amortization in the House bill shuts off that additional amortization, but maintains the amortization that they would get from their sports teams. There's also this really interesting provision in the House bill that came from something that the majority leader in the Senate, John Thune, had originally proposed. It's an expansion of the definition of medical expenses for purposes of getting reimbursed via your health savings account. So this provision allows people to get reimbursed $500 annually, $1,000 for couples, for things like gym membership, personal training, Peloton, things like that. Obviously, that's very helpful for companies like Planet Fitness and Equinox, but it's also beneficial for Peloton, as I said, and Apple Fitness, and also workout gear companies like Lululemon and Nike. And then The House bill would also expand the definition of good income for purposes of the publicly traded partnership tax rules to include compressed and liquid hydrogen and carbon capture. And that's really interesting. It's something that the Democrats actually have been talking about for a long time, and it's interesting that it's in a Republican bill. What it means is that even if Congress drops the hydrogen tax credit, which we think is likely, this provision will still incentivize companies to invest in hydrogen. Why? Because publicly traded partnerships go largely untaxed, right? The tax flows through to the unit holders, but only if they follow very strict tax rules. And most of that boils down to the company ensuring that 90% of its income fits into the strict income categories that are listed in Section 7704, which is the publicly traded partnership section of the code. By expanding that list, it's a huge incentive to PTPs to expand into hydrogen and carbon capture, and it's an incentive to corporations that already do these activities to convert into a publicly traded partnership. The House Republicans would also raise the reporting threshold for payments to non-employees from $600 to $20,000 and 200 transactions annually. So why does this matter? Well, for gig workers, there's no good way for the IRS to figure out how much they earn annually because it's from so many different sources. So the IRS has to it's forced to compile the records of the people paying them. And if the reporting threshold rises from $600 to $20,000 and 200 transactions annually, it essentially shuts off the ability of the IRS to determine if gig workers are accurately stating their taxable income. And this is also a big deal for electronic payment companies like PayPal and Zelle and Venmo. A low reporting threshold means that their compliance costs go sky high. So they're definitely pushing for that much higher reporting trigger. There's also a relatively massive benefit for companies like H&R Block and Intuit that I mentioned. The IRS has been rolling out Direct File, which offers free tax filing services for 20% of all U.S. taxpayers. The House GOP bill would kill Direct File, but it also creates a task force that would determine how to replace Direct File with a new and improved Free File system. And if you haven't heard of Free File, that's not surprising. It was a partnership of companies like Intuit and H&R Block, Jackson Hewitt, and the other tax software leaders. And they were through this partnership, they were offering their software for free to lower-income taxpayers. It was a voluntary system, and companies agreed to offer free tax compliance because the government had threatened. They said, if you don't do this for us, then we're going to introduce our own free online filing service. Well, Intuit and H&R Block dropped out of Free File, and the government followed through on its promise and introduced Direct File to compete with them. But with Direct File gone, and having shown that the government really can't compete with Intuit and Block, it's our view that the government would probably need to incentivize Block and Intuit to rejoin this new Free File. And additionally, the bill says that they want to offer free tax compliance to 70% of taxpayers. Well, Intuit and Block have about 80% of the tax software users. So obviously they're going to be the ones that the government needs to reach out to get them to do this for them. And there's really no good way to do that unless the government pays these tax filing software providers directly. So we think that will be a huge win for these two companies. And lastly, I wanted to talk about these Trump accounts, right? These are like souped up 529 plans. And if you haven't heard of Trump accounts, maybe you've heard of the previous incarnation of these things that were also called MAGA accounts in the original version of the House bill. They're basically tax-advantaged investment accounts for kids, children 17 years old and under, and they tax all withdrawals from the funds at a long-term capital gains rate once a child reaches the age of 2025. Contributions would be limited to $5,000 annually, but they're broader than 529 plans. They could be used not only for education, but also for small business loans and for first-time home purchases. And the real kicker here is that the government would deposit $1,000 in each of these accounts that are set up for children born between 2025 and 2028. So there's a lot of really interesting stuff in these two bills, or in the House bill that we think will end up in the Senate bill. And it remains to be seen whether all these things will remain after the Senate does its work. We may even find out as soon as today, and I'm recording this on Friday the 13th, June 13th, 2025. I find this really interesting. I haven't read about a lot of these proposals, but now you know after watching this video. So thanks for listening and for reading my notes, and I will be in touch again soon with a new note and a new video summary.